Welcome back, ladies and gentlemen. Thank you all for joining me today. I'm really excited to show you guys Daily Journal Corp, or DJCO as the ticker is. Now, this is a company, it's $367 million market cap as of making this video, so it's very tiny. It's not on a lot of people's radars. Even the people that go to the Daily Journal meetings every single year with Charlie Munger don't really ask that much about the business. Now, I found this opportunity between Guy Spear and Matthew Peterson on YouTube. I was listening to a couple of interviews on YouTube, and Matt actually has a channel where he posts a lot of his interview clips and things like that as well. So I was watching through and looking at the Daily Journal investment presentations that he did, along with Guy and him talking about it. And I don't know, something clicked when I was looking into this business. I really liked what I see. And so I was like, okay, let me do a little bit more of a deeper dive, try to get an understanding so that way I can kind of compare what he has with what I have and try not to just see it through like the rose-colored glasses. So what I found was it's really like he had said, it's a traditional newspaper business transitioning into a software as a service business, so SaaS business, and really they're in the early stages right now. And I do think though that there obviously are going to be some risks and things like that, but the whole TLDR of this is that I think it's probably at about fair value here today at $367 million. And you're going to see that at the end, give or take 50 million. I could be wrong on the downside, could be wrong on the upside. So give or take 50 million. I think it's probably, right around fair value. So I'm looking to buy as this keeps going down, and I do own a couple shares right now. So with that being said, let's dive into Daily Journal. Let's get some knowledge. Let's do this. So as I had mentioned, we're going to go straight into the company. And really the way that they break this out is you have Daily Journal Corp, and underneath that you have the newspaper business segment. You have the Journal Technologies, which is that SaaS business segment. And then there's a huge investment portfolio. Now for the newspaper segment, I'm going to show you the newspapers very quickly, but I'm not going to, value it into the very end. And I'm not going to sort of, explain it all because that's not where the company's going. But just know that that is a traditional part of their business. It's what it used to be. It's now getting phased out as Journal Technologies becomes more and more relevant. Now, Journal Technologies, a SaaS business based out in Utah. They have a location down here in Los Angeles as well. So with that being said, it's going to be a sort of long process for each contract that they get, and you're going to see here in a moment really what all that is. But they focus primarily on court database management systems for legal courts like LA City Court, or LA County Court, or San Francisco, New York City, things like that. That's what they're focused on, is trying to get a database management system for each court and trying to compete with other different companies that are trying to do the same thing. Now the investment portfolio is run by Charlie Munger. I'm not 200% sure who's going to run it when he's gone, but it's a huge part of why I like this company so much, because it adds a sort of downside to this business. Now they break themselves again into three different parts, as I had mentioned. I'm going to list here the newspapers so that way you can just see it. It's really just the newspapers, the ads and things like that, and the online publications from all that. But really, these are kind of the big newspapers that they have. As I had mentioned, Journal Technologies, they have three sort of offerings, if you will. So they have e-court, e-prosecutor, e-defender, and e-probation. These are going to be things that sort of interact with each other, interact with outside agencies, and allow you to see what all that really looks like and be able to interact with other people in your organization if you work in these courts, so that way information can flow really easily. Because I didn't know if you know this, a lot of courts are still stuck in the Stone Age with paper, and you have to go do all these different things and actually go in and file, which is really annoying. So e-file is one of those big things too that's coming in between Journal Technologies and some of the other companies in this space. They're trying to bring in sort of this e-file and e-signature, and you're seeing a lot of that now, especially the companies like Dropbox that we had mentioned as well. That's not a court-based, but it's e-signature. So a lot of this is trying to transition everything in the courts to an online platform or technological-based platform. Then you have e-pay it, which is just going to be, if you get a traffic citation, you go online the website and you pay your citation there. I believe I'm not sure if it's LA County or LA City already has this e-pay it built in. You can see, copyrighted Journal Technologies 2022 down at the bottom of the website, which is really awesome. Now, the way that they break out everything, I'm just going to pop it up on the screen here. These are the reportable segments. So you have, again, traditional business, Journal Technologies, and the corporate income and expenses. So they separate out based on the line of business that they're trying to do, what exactly these expenses are for, and sort of where the sales are coming from. So you can see in 2022 from 2021, there was a slight decrease in this year, and this is the 9 months ended June 30th. Their next quarter ends That's going to be Q4, so their 10K should come out in September 30th, or that's what it's going to be through. But anyways, the total revenue, you can see it drops. So you have $23 million down from $26 million. What happens is their legacy system is now sunsetting. They're trying to get rid of it, not have to support it anymore, and they're trying to force all of those clients who are on it to either get on their system or, they can go to a different company or different company system, but they're trying to get them onto that new journal technology system. So you're going to see a lot of, decreases in the short term, but it's really to, help companies and help courts really get in for the long term. Now, the thing is too, that to note, the expenses are, recognized today. So if they spend on salary or spend on R&D or anything like that, any of that is going to be recognized today on the income statement. The revenue is going to be deferred until you actually sign, the courts actually sign for the software. They sign for these licenses and they give the green light for everything. So we're still waiting on, whether or not they're going to accept this, but the expenses are being accrued today. And normally what Matt found was that anywhere from 5 to 7 years seems to be the sweet spot in terms of where they find it. Now, lastly, for the corporate investments, they have a line marked unrealized losses and gains. You're going to see here in a second why the profitability is not reliable and a net income margin at least is not reliable. Now, diving into the financials, $46 million was the revenue for the TTM. And then you also can see here just sort of what that looks like. So in 2008, the traditional business did really, really well because of the fact that, a lot of people are foreclosing, a lot of bankruptcies happen. So you see that kind of dip as people stop needing that service. And then right around 2019, 2018, they started ramp up journal technologies and really sort of, try to get to where it is right now. So that's why you're seeing kind of this revenue. It's kind of lumpy in some places and kind of jumping in other places. The profit margin is something that I wanted to mention as well, because I'm going to pop it up on the screen right here. You can see the gross margin and the profit margin. I mean, this is kind of nuts. It goes from 99% down to negative 70% to, 200%. It's all over the place. And the really reason is because on a net income basis, on a net margin basis, under GAAP, you have to include those unrealized and realized gains and losses, because what happens is if the stock portfolio goes up 20%, the value of that is now included on the income statement, which doesn't make any sense to me. But if you use a net operating income rather than trying to, factor in this gains and loss, you'll get a better idea. Luckily for us, the net income is broken out by segment. So if you're looking at a specific segment, you can see it there. The way that I did this, because again, PE and EV to EBITDA aren't really that relevant in this case, because they're not really making any money on the journal technologies side of the business, is the current price to book ratio. So the current PB is a 1.65, and that's down pretty far from where it has been in the past. You can see over the last couple of years, it's hovered probably closer to 2.5, which is fine. But again, it all goes back to what that book value is actually worth and what's driving that denominator, not so much the price itself. So you can see the EV to EBITDA, 2.35. Then the current cash on the balance sheet is $8.9 million, along with the debt on the balance sheet is around $76 million. So with that being said, though, I'm just going to kind of walk through the TAM and competitors, strengths, weaknesses, and then finish off with the valuation. So the TAM is really, there's thousands of courts. There's thousands of courts across the United States. And the great thing is they're not just focusing on the United States. They're also looking elsewhere in international. I believe they had an RFP, a request for proposal. They had an RFP, I think, with Australia around like $89 million was what it was valued at. So it's gonna be, once this starts rolling out, once they start doing really well, once all the learnings and mistakes and things and whatever happens, it starts rolling out, you'll start to see this sort of, all of a sudden you'll see this revenue start appearing. So that's one thing I wanted to mention, is kind of the timeline that this all runs on and sort of what that all looks like. Now, Tyler Technologies is really the big competitor in this space. They have tons of already established contracts. They have a ton of RFPs that are already out there, and really they're dominating this market right now. Not that Journal Technologies can't get there because they run a different business model, but really Tyler Technologies is sort of the dominant player in this space. So if you're going to get in this company, make sure you kind of understand what that all looks like. Currently, Journal Technologies is in about 400 courts, justice agencies, and things like that. So, and that's down from 500 that they originally had because of the fact that they got rid of that legacy system. One last thing that I want to mention about Tyler Technologies, they have over 26,000 successful installations, and this is across their entire company, not just, across the courts. They have 26,000 successful installations, which is, that's a really good sign that they're doing well, but I think that Journal Technologies, as these start rolling out, you start seeing all the contracts pop up. That's really where you're going to see the same thing too, where, the way that this business model works is basically, they're going to delay their sort of gratification of recognizing that revenue, and they're also going to take the expenses up front from the customer, set everything up, host the database, and host the servers, really. So they don't have to worry about, doing all of this work themselves, the courts at least. And so the benefit of that is now that because Journal Technologies is in a financial position because it's under Daily Journal, they can, do things that probably other companies can't because they don't have the financial position to do so, or, it's not profitable in a certain way, or things like that. Now, going on to the strengths, the first thing that I wanted to mention, going back to it, was the delayed gratification and the competitive edge. I'm going to pop up one of Matt's slides, and he really shows what this contract timeline looks like. So in the first year, you have the RFP. The first, second, third year, really, you kind of work out what the scope looks like, what is the statement of work, what is, all the setup's going to be like. You have to establish the AWS and on-site servers, and then you install the different suite and different software and kind of set everything up. So anywhere from 5 to 7 years is really what you're looking at. And the goal of their contract timeline is to prevent the government from needing to invest into their own database and servers while checking every box needed by the users. So it's customized to whatever the court needs at a specific time, and they don't charge them again until it goes live. So that's one of the great things, is they don't get the billing until it goes live. Now, the second thing that I wanted to point out is their fortress balance sheet. So if you take a look, and we're going to look at this in the valuation as well, if you take a look at their marketable securities, you take a look at their real estate, you take a look at their cash on hand, it's enormous when compared to the liability side of their balance sheet. Really what you're going to see on the liabilities is margin loan or margin account borrowing. So they have a 2.5% interest margin loan that they've been using against their investment portfolio. And part of that was to do acquisitions a few years ago. And then I believe now they use, I want to say, $35 million of that to buy some Baba stock and then sell it off. They did some, financials trickery. I don't want to call it trickery, but they did some financial movement with the increased amount. So really what they're trying to do is just, use it to buy some companies, and then that's, what's going to be on that margin loan, because it's such a low interest rate that they probably make just on the dividends alone of their current investment portfolio. They probably cover this margin loan. So on top of that, they have it says notes collateralized by real estate. And really what that is that's a mortgage, and the mortgage rate is super, super low as well. And the offices in Utah and in Los Angeles here, they are not on the, on their balance sheet at like mark to market. So meaning they're not valued how they would be valued today. They're actually at the book value of what they were at the time that they were bought, which is fine with me because that just is them being conservative, but it's something I want to note because really you can see here that the real estate that they have in LA, the real estate they have in Utah is probably higher than what is actually shown on the balance sheet. Now, the third thing that I wanted to mention as far as strengths goes, the barrier to entry in the sticky software. So the big piece of this and why it's a barrier to entry is the bureaucratic process of 5 to 7 year RFP, along with the fact that, they have all these asks and they don't want to pay for everything. You have to be consider their budget and things like that. All of that good stuff that goes into working with the government, and really what that all looks like. And the thing is that because once you get in, they're not going to want to go through this whole process again. They're not going to want to have to, get a whole different provider just to do this again. And it's going to be a sticky software, and any upgrade, if they haven't been brought online yet, is going to be significant as far as technological advances go. And so it's important that you understand that it's very hard to, remove someone who's already established. And that's why it's important that Journal Technologies moves to get these RFPs for different courts that they're not currently in versus Tyler Technologies getting them, as well as making sure that they set up, a sticky license that's not going to overcharge the courts too much or any of their other clients or consumers. And then as well as, as companies start interacting or courts start interacting with these systems, both internal and external, it would kind of like a network effect where, we want to know more about this. We want to learn about this. Let's, set up a meeting. Let's talk about it, and then kind of start this snowball effect to each court that they work with, because it's going to make the data flow easier if all of these courts are online on the same system. So that's one thing I really like. Now, diving into the risk, the first thing that I wanted to mention, and this is kind of like a half and half risk, half strength, is the fact that the management is transitioning. So Gerry, Salzman, as well as Charlie Munger have both retired. There's been a couple other retirements, but these were sort of the two that I guess were more prominent in the company, because Gerry was really the CEO, CFO, and I believe he had another position like secretary or something like that. But he really was the sort of driving factor between all this, which is really odd. But what they did is they found a new CEO. They promoted Tuto from a controller position, senior controller position, to the CFO position. So there's a lot of other people internally that kind of got promoted to either the CTOs, or they got promoted to president, or things like that. So, and one of the best things is that this management didn't used to have a technological background. So Gerald Salzman, as well as Charlie Munger, don't really have a technological background as far as running a tech business. So now that they've brought in the new CEO, Stephen Myhill-Jones, he was a startup founder, and Charlie Munger seems to love him. And I'll just pop up a quote here on the screen of what Charlie Munger really said about him. But he seems to like him a lot, which honestly, if you can get any sort of nice thing said about yourself from Charlie, I feel like that's a win. And also on top of that, so Stephen came from a tech startup background, as well as he sold that company off and then went into angel investing, as well as some venture capital experience. And really what that all means is that he has experience building up a tech company, running it, and then selling it. But in this case, he's just trying to run it and really build it up to what it truly can be. So I really do like that they decided to step down, allow someone who's more technological, knowledge and experience to actually run the business, as well as the fact that Charlie Munger is the person who ran the investment portfolio. So I didn't see anything particular that says who's going to run it. I don't know if he still is, but I'm going to see if I can find more data on that and see if I can find more, just anyone from anywhere inside the company saying, oh, so-and-so is running it now, or if they're just going to leave the investment portfolio alone, which is probably fine given what's in it. So I'm totally fine with that. Now, the second thing that I want to talk about as far as the risk go is the go live, delays and kind of the scope creep. So really what that all means is the fact that, if something goes wrong, if there's a mistake, if the customer's not happy, it can delay the go live, and meaning that can delay the revenue from appearing on the financial statements. And also the scope creep, meaning sort of, hey, we want to bring in this, or we want to bring in this. We also want to bring in this, and just continually building on top of that what that actually is going to involve. And so, because they set everything up with estimates and all that, and then, they finally put everything together. So it is going to be an interesting opportunity. I do think that the company has a good runway in front of it. It's just a matter of whether or not it can execute. And you can actually find a lot of these sort of court RFPs or court documents or court contracts. If you go search like LA Court, Journal Technologies, RFP or something like that, it'll pop up as like the first thing. Matt and his, I believe his intern, I don't want to say intern, analyst, I think it was an analyst, they went through and put in hours and found 100, 150 contracts, and it's a lot of money that it's going to be giving. So it is interesting. Read over the contracts to get an idea of how they're structuring these. I have like a few that I downloaded that I read through that I thought were pretty interesting as far as the billing goes and things like that. Now, the one thing that I wanted to end on really was the valuation. So I'm going to pop up a valuation here on the screen, and the way that this is going to look for you is, so on the left, you're going to see a present value of JTI, of what I think it is, and then on the right, you're going to see a net asset value. So for JTI present valuation, what I did was I took the revenue from 2021, grew that at 12% per year. Now, obviously, these are all estimates, assumptions, things built into it, so it's probably wrong by a lot, but I just wanted to get like a ballpark and kind of get an idea of what we're looking at. But anyways, so 2021 actuals just grew that by 12%. Matt thinks it can get to $100 million by the end of the decade. I probably think that's about on track as well. So let's assume they get to $95 million in 2030, as well as the net income. The way I did this was I just, I took the 2021 net income, because I think it's probably close, and just basically, just went through, and this is net income for JTI, not for the whole business. So 3.7%, and just slowly grew that down to 10% in 2030. And then at the exit multiple, I used a 15x PE for 2030 to exit. So really what that leaves you with when you take a present value at a 10% discount rate is $79.228 million. So that's the present value, at least of what I have calculated. Whether or not that is 100% correct, I don't know, obviously. It's almost 8 years from now. So I'm fine with that, though. I think that's probably relatively safe. I think it's probably should be a little bit lower, maybe even, lower the multiple, lower the growth rate. That's totally fine. On the right side, what I did is I just took their equity holdings based on their 13F and based on what's on the balance sheet. So the total equity in the market, or really the marketable securities, is $341 million. That's made up of Bank of America, Wells Fargo, US Bank, POSCO, Alibaba, and BYD. Now, I don't know if BYD is the full foreign, company that's on the balance sheet. I don't know if they bought something else. Charlie Munger is very hush, tight-lipped about any sort of movements in the portfolio. He doesn't talk about it if he doesn't need to. He probably wouldn't even put out 13F if it wasn't required. So I'm just using BYD as that placeholder, the 166 million, but it's possible that that is split between two companies rather than just BYD. So adding to that, I just add the cash of 8.8 million, add the real estate at book value, 16.3 million. That comes out to $367 million worth of total assets. And obviously there was some other stuff on there like AR and things like that, but I'm just not going to include that for this valuation. Then you take out the debt, so investment margin, account borrowings, note payable collateralized by real estate, and then deferred income taxes. Deferred income taxes is balanced against the investment portfolio. So like if you were to sell it today, sell everything today, what would that look like? So $127 million is what I get for the total debt. Subtracting 367 million from 127 million, I come out to about $240 million. So add those together though now, and you get about $320 million, $319 million. So I think that at $367 million, it's probably around fair value. Like I mentioned earlier in the video, the TLDR, I think plus or minus 50 million is probably in the range of fair value. Obviously, it could be different if the company fundamentals change or if it starts growing like crazy or starts declining like crazy. And then one thing I did want to mention too was the fact that I used a PE multiple for this valuation. The price to sales of Tyler Technologies as a company is about 10. So if I would have used revenue, at 2030 at a 10 multiple, be a totally different story. But I just wanted to do a PE because I think it's a good rough estimate and kind of a good idea of where we could be. But other than that, I don't have anything else to mention. So thank you all for watching. I hope you're really interested in Daily Journal. I thought it was really interesting. That's why I wanted to go into it and sort of present it. And obviously, as I had mentioned earlier, the valuation is not perfect. Like we went through this in a Discord group. The equity portion, if it dropped all of a sudden, obviously that can cause issues in terms of the whole valuation metric. So that is something to note as well. If a company, in this went from, 100% to zero or something like that, that would be absolutely insane, but it could happen, or it can go peak to trough 50%. So it's not going to be anything, sustainable or crazy. They obviously need to build JTI, especially because Charlie Munger is going to end up leaving the company eventually. I really do think, though, that the opportunity is there. I like JTI. I like the RFPs and contracts that I've been reading. I like the opportunity for everything else. So it'll be an interesting business to follow and track here on the channel. Make sure to update you if I have anything new or anything kind of comes up. But I'm just going to keep talking about this in my portfolio when I do those videos every single month. But other than that, unless something significant happens, this is probably the only video I'm going to make on this. But with that being said, thank you all for watching today. I hope you enjoyed the video. Happy investing. Have a great day.